Today we will discuss about what is technical analysis. Security analysis is divided into two types, fundamental analysis and technical analysis. Fundamental analysis discuss about the fundamental factors which affect economy, industry, and company. Technical analysis is the process of predicting the price movements of tradable instruments using historical trading charts and market data. Technical analysis can be defined as an art and science of forecasting future prices based on an examination of the past price movements. It involves putting stock information like prices, volume, and open interest on a chart and applying various patterns and indicators to it in order to assess the future price movements. The time period includes or it ranges from intraday to week, month, or maybe even years. So, technical analysis means it is a process of finding or identifying the future patterns of price stock movements based on previous prices. So this is a pictorial representation of technical analysis. Traders, investors, and analysts uses the historical prices, market data, trading volume, chart to, to create chart, identify patterns and trends associated with the data. With help of these patterns and trends, they forecast the price movements of the particular security in the future. So they identify spot potential, short-term and long-term investment opportunities. What are the three basic assumptions of technical analysis? The market discounts everything, price moves in trends, history tends to repeat itself. These are the three basic assumptions. Market discounts everything means whatever information is available in the market, whether positive or negative, with respect to the economy or with respect to the company, that will be reflected in the stock market prices accordingly. Price moves in trend. That is, the prices of securities in the stock market will be moving in a particular trend or a pattern, and by identifying that trend, we can predict the future prices. History repeats itself. So, prediction means using the previous trend means that same pattern can be repeated in the future. That is a third assumption. The first assumption is market discounts everything. Technical analysis assumes that at any given time, a stock market price reflects everything that has or could affect the company, including its fundamental factors. It is believed that the company's fundamentals, along with broader economic factors and market psychology, all are priced into the stock, removing the need of actually considering these factors separately. This only leaves the analysis of price movements, which technical theory views as a product of the supply and demand for a particular stock in the market. Second assumption is price moves in trend. Trade with a trend is a basic logic behind technical analysis. Once a trend has been established, the future price movement is more likely to be in the same direction as the trend than to be against it. Technical analysis frames strategies based on this assumption. So maybe different types of trends are there. Based on that trend, so the price will be moving. History repeats itself. History tends to repeat itself. People have been using charts and patterns for several decades to demonstrate patterns in price movements that often repeat themselves. The repetitive nature of price movements is attributed to market psychology. In other words, market participants tend to provide a consistent reaction to similar market stimuli over time. Technical analysis uses chart patterns to analyze market movements and understand the trend. So, the technical analysis basically depends upon these three assumptions. History repeats itself, price moves in trend, and market discounts everything. So, based on technical analysis, an investor or an analyst can predict the future